Hello, everyone, and welcome to the third webinar in our Janover webinar series. This webinar, we're going to focus on the real estate industry and the effects that the coronavirus is having. And today, we're very lucky to have three spectacular speakers. We have Gianluca Carobs of Janover, Anthony Coniglio of NewLake Capital Partners, and Ari Davis of Tannenbaum Helpern. So I will give them each a moment to introduce themselves, but just to get some bookkeeping out of the way, please note that we're not giving any advice. Please don't interpret anything here today as specific advice. If you have any questions, if you want to reach out, the Q&A is open, and please feel free after this webinar to reach out to us. So with that, I'll turn it over to Luca.
I am Gianluca Carobs. I'm a senior tax manager at Janover LLC. Janover is a full-service tax accounting and consulting firm, over 80 years experience in this profession. Not me personally, but the firm.
Are you sure?
And, yeah, I'm not that old yet, and that's about it.
All right, great. Thanks, Luca. Anthony?
Yes, thank you for having me today. Good afternoon, everyone. I'm Anthony Coniglio, CEO of NewLake Capital Partners. We're a real estate company focused on building a diversified portfolio of retail and industrial properties that we lease to companies, in particular in the cannabis sector, for use as dispensaries, as well as cultivation, processing, and manufacturing facilities. We acquire our properties using sell-leaseback transactions, and our tenants are some of the most experienced and well-run businesses in the industry, companies such as Grassroots, Columbia Care, and PharmaCann. We earn revenue by charging rent. Our investors receive a nice, healthy quarterly dividend, and we believe there will be significant appreciation in the value of our portfolio as the legal status of cannabis changes over time. Obviously, these are volatile times, and we're excited to join you today and talk about how this is impacting real estate.
All right, Anthony, thank you so much. And Ari?
Great, thanks, Zach. Hi, everybody. My name is Ari Davis. I'm a partner at Tannenbaum, Helpern in Syracuse and Hirschtritt, which is a mid-size commercial general practice law firm in New York City. I personally work in the commercial real estate and construction department, where my focus is generally on transactional real estate, such as sales and acquisitions, financings for both borrowers and lenders, as well as leases for landlords and tenants. As you can imagine, even with COVID-19 shutting down most of the country, our firm's attorneys are staying busy, keeping on top of the daily changing landscape with respect to all matters, including employment, corporate matters, including the SBA legislation, bankruptcy, litigation, construction tax, and of course, real estate. And it's a pleasure to join you guys today.
Great. Well, we're so glad to have this illustrious panel with us. So we wanted to start off with Anthony, and from your seat, what are you seeing in the industry? I mean, I know that really not much is going on right now, but maybe just over the last couple of months, what have you seen and how are you reacting at this point?
Yes. Well, to state the obvious, the current state of the market is volatile, to say the least, with tremendous anxiety about what the next couple of weeks will hold. Will rent payments come in? When will the CMBS market reopen? Will banks be forgiving on debt payments? Will the CARES Act provide the intended relief? And will it be in time to deal with the issues I just mentioned? One's level of anxiety is also dependent on what sector of real estate you look at. For example, if you focus on logistics, data centers, or healthcare, the impact is less than if you focus on restaurants, retail, and hospitality. For multifamily, the unknown about how many people will not pay rent because they know evictions are temporarily prohibited in certain jurisdictions, that unknown is pretty massive. There's also talk, many of you have probably heard, there's talk of rent strikes in New York, Boston, San Francisco, and other cities. Again, the CARES Act is intended to provide relief, but since cash won't flow for a few weeks, it's not clear that April, or it is clear that April will be a volatile period. On the large landlord side, they're having very different responses. We've seen Tannenbaum, which owns 26 malls across the U.S., announce that they expect their tenants to pay rent, whereas Walmart and Publix are forgiving rent for April and in some cases May. Walmart has over 10,000 spaces within its real estate portfolio, and Publix has over 1,200 shopping centers, both of which house many small businesses. This will help, but it remains a small segment of the overall problem. Now, we're also seeing some landlords who are being proactive in restructuring leases to address tenant issues. And I hear that many retailers will just simply not pay their rent. And many landlords are also telling their tenants to look to their business interruption insurance. It's an unsettling time for all involved. However, as I was reflecting on preparing for this discussion, I did want to sound more of an optimistic note here. Through all this uncertainty, I do see some emerging positives. I think the CARES Act appears to be positioned to help bridge the gap. However, as we know, there are many aspects of the rules that need to be sorted out by the SBA and other agencies in the coming week or two. If it's rolled out efficiently and comprehensively, it could provide the much needed cash flow for businesses and landlords alike. And I'm also seeing more constructive dialogues between landlords and tenants as both understand that symbiotic relationship and that they really both have to be getting through the crisis and finding a path back to prosperity together. One can't survive without the other. And so I am an optimist by nature, but I do think while we will have a significant period of uncertainty as April unfolds, I am hopeful that we'll be able to figure out a way to work through it by working together and really leaning on some of the programs that the federal government has provided us.
That was an amazingly positive tone, and I think that's something that we all definitely need to hear. That was an incredible introduction. I think there's a few points in there that we'll definitely dive into as we move along. I do want to pass it to Ari. Ari, from your perspective, what are you seeing right now?
Sure, I'm going to echo some of what Anthony just said and get a little more granular in terms of the legal aspects. But excuse me, starting generally, we are seeing deals continuing. Deals that we're in the middle of have not stopped. And that's my optimistic note. That is not, sure, there are some deals that have fallen apart, but people want to get deals done. It's not just that people are seeing the market saying, I don't know what's going to happen. I want out. There are people who want to get to the finish line, whether it's in refinances, acquisitions. Obviously, everything's going a lot slower, though, as people are trying to figure out what's up and what's down. And especially, refinancing. I've gotten a couple new refinancings lately. People still want to go forward with those, do their due diligence. Sure, closings may not occur until after April, after May, depending on when this all ends, but they want to at least get the process started. People aren't seeing this as the world is ending, I'm done with real estate. So there is note for optimism in that. Touching on a point that Anthony had mentioned, there definitely is a lot of uncertainty. And from the legal standpoint, it's uncertainty as I can't close because the recording offices aren't open. How am I going to sign an original document because there are no notaries available? I can't pay my retail rent because my store is closed, or like Anthony mentioned, I've just received a letter from 5 of my tenants. They're not paying rent. So how can I pay my monthly mortgage payments? Generally, what we're telling clients is you got to look at the documents, whether it's a lease, financing instrument, whatever. You've got to look at what the documents actually say in terms of your rights. One term that I've seen come up a lot, it's kind of an like the expression, the face that only a mother can love. This is a term that only a real estate attorney would enjoy, force majeure. You're hearing that term a lot. For those who don't know, that's unavoidable delay is the short definition of it. And people don't really know what they are. They're hearing these terms, oh, there's force majeure, I can't perform, I don't need to perform. And the problem isn't just generally, I know we're going to get into the details later, but a force majeure clause is really, I can't perform because of a certain event, whether it's a act of God or something to that effect. But since thankfully none of us have been alive since 1918 doing real estate contracts since then, I hope that's the case and nobody's been doing real estate deals since then. The force majeure clause often don't cover this scenario that we're in, especially when it comes to making payments. So you are seeing a lot of uncertainty in the market in terms of how we're going to go forward with performing.
Now, I thought you brought up a pretty interesting point that I just want to dive into quickly. You mentioned that refinancing and closing, the processes were different. Do you mind elaborating a bit?
Sure. Well, with refinancing, there is a long period, depending obviously on how quickly borrowers and banks are moving. But there's a lot of due diligence involved. First, with refinancing, they've got to look at the property. The lender wants to see how the property is performing, how the leases are doing, who their borrower is, what their organizational structure is. So they can still do that. Like obviously, like Anthony mentioned, rents aren't coming in, and the financial stability of a property may be in question. But the lenders are able to do their diligence in terms of who the organization is, and at least get some of that grunt work out of the way. And even in terms of drafting legal documents, in terms of the loan documents, lenders can still generate loan documents through their attorneys. It's a matter of getting to the finish line in terms of recording a mortgage where people are running into issues.
Great, thank you. That was very interesting. We'll see how this continues to adapt as we move forward. Luca, from your perspective as a tax manager, what are you seeing right now?
So Janover has been, first off, Janover provides tax and accounting services to a large number of real estate clients. It's a big part of our practice. Since day one, we've been yielding questions left and right about what the implications are of not getting paid rent, not being able to pay the mortgage, etc., from all small, medium, and large real estate clients. Small businesses aren't able to pay their rent. The revenues have gone down to zero. Large businesses are going to opt to not pay the rent as businesses shut down. Some of the essential businesses are going to have to pay their employees and maybe forego the rent. Long term, this pandemic is going to lead to potentially more tenant favorable regulations. There's potential for foreclosures in the future if rent doesn't come in. And there are a tremendous amount of tax implications to that. The CARES Act that we're going to get into a little later provides some relief, both on the SBA loan side as well as several tax rule changes that are going to be in effect for several years. So, the real estate market right now is hurting. Rent rates decreasing, potentially office space not being utilized. Retail is obviously a huge market that has taken a huge hit, and we're on the phone with the clients all day trying to figure out what the ramifications are on the tax side, as well as any potential benefit from the CARES Act or any other tax rule changes that are going to be in effect.
Great, and I know we could spend the next week talking about some of the ramifications, some specific outcomes. What has been most surprising to you at this point, Luca? I'll start with you.
The most surprising, well, first off, how quickly legislation has been drafted and voted into law, both at the federal and state levels. It goes to show, when lives are at stake, politics have to be set aside. 2.2 trillion was drafted, voted in, a week or 10 days or whatever it was. The most surprising thing, maybe it's not really that surprising, is the eviction restrictions. It's going to put a huge damper on the real estate industry. But at the same time, when tenants don't have cash, and a lot of, especially on the residential side, on the lower income side, they just can't make these payments. So the dramatic economic impact that this is going to have, both short and long term, is incredible.
I think that's certainly an understatement, but it remains to be seen how everyone will adapt, specific in the real estate space. Ari, same question to you. What's been most surprising from your seat?
Sure. The most surprising thing, Zach, actually has been the amount of dialogue being encouraged and actually taking place between landlords and tenants and borrowers and lenders. Because like I mentioned, we're always telling our clients, look, the first thing you need to look at is the operative document, whether it's the contract, the lease, or the loan document. But as I mentioned, a lot of times with this situation, it's not covered in there. So again, it's a case-by-case scenario, but assuming there isn't anything or nothing clear in your document, or even if there is something in your operative document, we're telling our clients, pick up the phone or write a letter and talk to the other side with an explanation of how your business and cash flow has been impacted. And a part of that is you've got to provide a reasonable proposal for how you want to go forward. And I heard this anecdotally yesterday that no lender wants to hear, or no landlord wants to hear a legal argument, there's a frustration of purpose under the lease, so I can't perform. They don't want to hear that. What they're going to do is that landlord is going to send that letter right to his lawyer, who's going to write back, no, you're still obligated to perform. They're much more likely to understand a personal, my business is shut. Can I have 3 months of suspended rent payments? And then I'm going to pay it back incrementally afterwards. And again, same is true with borrowers talking to lenders. We're not dealing with legal arguments. We're dealing with, hey, we're all in this together. We need to find a practical solution that makes both sides happy. And to me, that's the most surprising thing. At the end of the day, it's not about law. It's about being people and talking to each other and working at a solution that will get us all through this together.
So what you're saying is it's a generally positive surprise that communication lines have been so open, that they have moved as fluidly as they have?
Correct. And, it remains to be seen, though, whether that's actually, how that's actually going to play out. Right now, I'd say that's all positive. We'll see how the lenders and how the landlords respond. But at this point, I think it is still positive. And I think it's a very positive thing that we're telling people and that people are listening to, hey, let me just pick up the phone and have a conversation, because your lender is understanding what the borrowers are going through. Your landlords understand what the tenants are going through. It's not just like, oh, it's happening to them, it doesn't affect me. This pandemic is affecting everybody. And I really do think that people want to work together.
And I think this hits on Luca's point as well, just how quickly this has moved and how all parties have been aligned in making sure that we do all get through this together. It's been an amazing phenomenon. So, exactly. Anthony, from your seat as well, what's been most surprising for you at this point?
Yeah, I guess I'm going to take that a little different direction. I would play off of what Ari was just saying. And I wanted to provide for everybody a little bit more context, at least from my perspective, of some of the dialogues that are starting to happen. And think about this from the tenant side. The tenants are making strategic decisions every single day about what to pay and what not to pay. I've done some restructuring work in my career, and the first thing you do in a crisis like this is you run a 13-week cash flow model and you stop paying bills that you don't absolutely have to pay so that you can preserve cash. In some cases, it's not paying suppliers. It's elongating the terms you're getting from suppliers. In some cases, it's deferring CapEx. In some cases, it's layoffs to reduce compensation expense. And in many cases, it's lease payments. And so, as Ari pointed out, people will look at the document and they will look for an opportunity or an out. Some will take the constructive path, but others will, I believe, will just make the simple decision to default, just to not pay, even if they can't work it out. And the thought process is as follows. If you're trying to preserve cash and you're trying to keep your business afloat and your doors are shut, the landlord's most significant lever in a default situation is to not allow access to the site so the business cannot operate. In this environment, that lever doesn't exist for a company that has already seen its doors shuttered by the government, by local and federal governments. So in that environment, I could see some CFOs saying, I'll just not pay rent. What are they going to do? Lock the doors and not let our team in? We're not going in anyway. And then we'll figure it out when the doors reopen. Then I'll get myself back on. If I can't come to a deal today, they'll come to a deal in the future, because when the world starts to go back to work again, this landlord is going to want to have some cash flow. This landlord won't have the opportunities to relet my space that they would in a normal operating environment. So that's some of the mindset on the tenant side. On the landlord side, they have their own cash flow pressures. And since many landlords use debt and have monthly interest payments to make, they're under significant pressure to get as much cash in the door while trying to be constructive. And then I think many landlords, as I talk to them and as we think about our own business, what you want to do is you want to be supportive as a landlord, but you also don't want to take on somebody else's problem. You don't want to be more supportive than you necessarily have to be. So if a CFO is arguing reduced cash flows, I'll give you a live example in a moment, it would be, I guess to say it differently, as the landlord, you don't want to take their cash flow and balance sheet problems and impose them on your own balance sheet and your own cash flow. In our business, we focus on cannabis companies. And in the states that we operate, they've been deemed essential. And in many cases, they have seen sales accelerate in the early part of the coronavirus. We do expect that the cannabis sector will persist and will perform well, even in an economic recession. And so we did have one conversation yesterday where we're getting paid rent for April, but the CFO called and said, there's uncertainty. We'd like to work something out. And I was very transparent and shared with him, while we want to be cooperative, we also understand that your underlying business is very healthy. And so why should we take on your desire to manage cash flow if your underlying business is healthy? And so if we see a diminution in your revenues to a significant period, then let's have that conversation. So we're opening a dialogue, and we will have a discussion with them over the course of the next couple of weeks to see how sales are trending for the month of April. But I do believe that it's a bit of this yin and yang, this push and pull, and this dance, quite frankly, that tenants and landlords will have. And so what's surprising to me, to come back to your specific answer, Zach, was the speed with which everything has occurred and the uncertainty with which the future holds. And that's what I think will drive this continued dance between landlords and tenants for the next 2 to 3 weeks before everybody figures out a real path forward. And part and parcel of that is understanding what tenants can get from the CARES Act. And so once those rules are finalized over the next 7 to 10 days, once the applications get into the SBA lenders, and once the tenants actually truly understand what their future cash flows will look like, then I think they'll be able to speak with more certainty to their landlords and other suppliers.
And at least at that specific moment in time, because as we've hit upon a couple times already, this is moving very quickly, and to say it's a moving target is an understatement. You hit on actually a very interesting point I just wanted to push into for a moment. You mentioned indirectly remote work and the fact that spaces are not being occupied right now, whether due to quarantine or due to just the fact that businesses in general have been adapting. How do you think that owners, operators, and even investors will take that into account? Is there a way that they adapt to businesses adapting to them in sort of a circular fashion?
So I have a couple of thoughts on that. I think number one, landlords will take that into account to the extent that they can. And go back to what I said about Walmart and Publix. Those businesses are essential businesses. They happen to have tenants within their real estate portfolio, whether it be optometry centers within Walmart stores that can't open anymore, or whether it be local restaurants or other retailers that are in a strip mall where a Publix is located. Those businesses have underlying strong fundamentals, and so they're in a position where they can forgive rent for a month or two, be upstanding citizens in their community, and win a PR battle, but also do their fair shares, so to speak, to support the economy. There are other landlords that may have the desire to do that, but don't have the economic ability to do that. So I think the answer to your question is going to be somewhat driven by what the landlord's ability is to be flexible. I think a more interesting question that I don't have an answer to, but I'll posit it here for everybody, is what is the long-term ramification from all of this? We'll set aside retail and hospitality, which are location-driven businesses, but whether working remotely works for people, and do we see a segment of the workforce not needing office space as much as they did? Is that a 1%, 3%, 5%, 8% impact on office space? Or is this an untenable situation, and anybody who is thinking about remote work will move back to housing people altogether? I tend to think that people will have enough forced time to figure it out on their own, And if I were a betting person, I would err on the side of expecting that we will see more remote work arrangements after this crisis than we did before it. That's just a personal opinion.
And what an opinion, to be honest. Do you see any other key ways that owners, operators, and tenants can work together? And I think you're in a pretty interesting position to answer that question.
Yeah, we do. So yes, and I agree with what Ari said. I think that open dialogue and having that conversation and figuring out what mechanisms work for the parties involved. Perhaps it's a percentage of rent arrangement when a business reopens so that the rental payments can flow based on how fast and how robust the business returns for that particular tenant. Perhaps it's an abatement. In some cases, it could be a rental extension. If someone's lease was coming up next year, perhaps they get a forbearance for 2 or 3 months for an additional 3 or 5 years on the lease. I think it will require both tenants and landlords to be thoughtful about each other's needs and to be thinking strategically about what their counterparties' needs are. And so is it rental relief for 3 months? Is it extension in term? I think that's the most important part of this. As Ari said, I can't reinforce it enough. It's having the dialogue and the open and honest and frank discussion between each other.
So I think our central point, and it's an amazing one, is communication from all ends. That's how we get through this together. That's how both sides remain as happy, for lack of a better term, as they could possibly be given the circumstances.
Zach, if I can interject first. Oh,
so
sorry,
I think one other point
beyond
beyond the communication. I'm sorry, and then I'm going to turn it over. Is yes on communication, but within communication, building transparency and trust. Because the moment one party feels the other one isn't being honest about their position and looking for an upper hand or an advantage in that conversation, trust breaks down and the ability to really truly move the needle becomes diminished. I'll stop there.
And Ari, I think you had a follow-up?
Yeah, I was actually going to build on Anthony's point. I think he made an excellent point. It was actually a legal point, which I totally agree with, where he said, don't be more supportive than you need to be. And it's all nice and good, like we mentioned, in terms of opening the dialogue, being transparent. At the same time, you still need to protect yourself. From Anthony's perspective, as a landlord, before you give any rent reduction, you have to check your loan documents, because there could be an event of default in there if you're giving a rent reduction to a tenant without lender consent. So again, yes, we need to be open, we need to be working together, but we could also still look out for making sure we don't trigger any defaults under our documents, or even look what you can get benefit for yourself from. Like as Anthony mentioned, for example, like if you're a landlord who's willing to give a rent reduction, still look at the tenant financials, like Anthony mentioned. If there's, for some reason, you see, hey, you know what, other tenants are folding, I could really use an extension of a term from this tenant. If I see that he's viable, go for it. Try working that into the modification you're trying to do with them. If you think, hey, you know what, this could happen again, I want an increase of security deposit now. Now is the time to do that. Definitely be transparent, definitely work with them. At the same time, don't lose sight of making yourself in a worse position than you were beforehand.
Do you foresee contracts, leases, loan documents changing going forward? Do you see any material effects from this crisis?
I definitely do. For example, let's turn to purchase and sale agreements for a second, since we've mostly been touching on leases and loan agreements. The due diligence provisions in terms of X amount of time to kick the tires on the property, and then you go hard after that in most contracts in terms of closing. I think that there's going to be a lot more conditions to closing that are going to be in there. I think that representations about the property are going to change significantly after this, because people are going to have to look at the properties and say, hey, I can't say that this property is in viable shape. So anybody who's been using a form contract, for example, they're going to really have to look at it in terms of even getting tenant estoppels. in today's environment, you're not going to knock on a door and get a tenant to stop from anybody. There are no tenants there. So I definitely think that contracts, for example, are going to change. I think leases are going to change. Loan agreement representations, financial covenants are going to change. I really think you're going to see definitely much more scrutiny of all of these documents and changing as applicable to each party.
And I'm assuming this is something you're preparing for already.
Oh, correct. Yeah, no, definitely. Like at this point, for better or for worse, everybody's kind of, not everybody, but a lot of people are holding off on new deals. But as we're going forward, we're looking at which contract provisions or which lease or which loan agreement provisions we're going to need to take a closer look at with our clients to go over whether they can still make those representations or agree to those covenants going forward.
Great. I mean, I can only imagine the amount of work that will have to go into making sure that we are covering some of these contingencies going forward. But that's quite the opportunity from your perspective, I'm sure.
Correct.
So to pivot the conversation to Luca, I know we teased this at the outset. It's time to talk a little bit about tax effects and the CARES Act. So Luca, do you mind walking us through in a bit more detail what you anticipate some of the substantial tax effects to be, and then maybe just guide us a bit through the CARES Act?
Sure. So I'm sure everybody's seen in the news, once the bill was passed, you saw all these articles about how much the real estate industry is going to benefit from this tax bill, from the CARES Act, which has several tax items in it. With regard to a non-tax item, it was brought up earlier. You have the potential for an SBA loan under the Paycheck Protection Program, with the potential for forgiveness of all or part of that loan. The caveat with that is it's mainly payroll driven, so you could have a lot of real estate entities and owner operators. They don't have much payroll, depending on the type of entity. If it's hotels, it's a different story, but they're completely shut down, so they might not be eligible for the forgiveness aspect of it. On the tax side, there are several items that impact real estate. One of the biggest ones was the technical correction to the Tax Cuts and Jobs Act with regard to qualified improvement property. This is, interior improvements to non-residential buildings. Those starting in 2018 was 39-year property, straight line, not eligible for 100% bonus depreciation. So this is a technical correction in order to properly classify these improvements as 15-year property. And with that, becomes 100% eligible for bonus depreciation. This is a huge turnaround for the real estate industry, hotels, commercial real estate, and it's going to be a huge impact. It's going to be retroactive to 2018. So the IRS and states are going to see a significant uptick on amended tax returns. Or you can do a catch up in 2019 with an accounting method change, but further guidance needs to come out with regard to how to do that. And this is you're going to see the cost segregation industry see an uptick as well. Now that this is going to be in place, there's going to be more of a benefit for cost segregation studies to chop down the building into certain segments to qualify for 15-year depreciation and bonus rather than 39-year straight line. So I think that's going to be a huge benefit for real estate. Next is going to be Code Section 461L has been modified, and what that is losses for non-corporate taxpayers were under the Tax Cuts and Jobs Act. They were limited. They limited pass-through losses to $250,000 or $500,000 single or married filing joint on a personal tax return. So you had significant losses, whether it be for depreciation or just your operations. In 18, if you had $1 million loss and you're married filing a joint, you'd only be limited to $500,000. The other $500,000 would get carried forward. So there's an issue there with regard to not being allowed to take those losses. So That's been lifted for 2018, 19, and 20, and they're going to be allowed unlimited losses for those tax years. So you're going to see an uptick of amended returns for that as well. The next item that changed is going to be the interest expense limitation. This is mainly for the larger entities, greater than $26 million, $25 million in 18 in gross receipts. The limitation was 30% of what they called adjusted taxable income, which was essentially EBITDA. They are in 2019 and 20 going to allow 50% of EBITDA rather than the 30. So you're going to see an increase in allowed interest deduction for those years. There's one caveat for partnerships. There's special rules and elections that are going to be in place. I'm not going to get into that because it gets technical and further guidance needs to come out. But essentially in 2019, you're not allowed the 50% increase, the increase to 50% at the partnership level. And the rules get complicated, but you will in 2020. So really, what do all these provisions in the CARES Act, potentially lead to? They lead to losses. With these losses, they also changed two other tax provisions in the CARES Act. One being net operating losses are no longer going to be subject to the 80% of taxable income. That's going to be for the 2018, 19, and 20 tax years. And I think the biggest one is going to be the net operating loss carryback provision. What's going to happen is for NOLs arising in 2018, 19, and 20, you can carry back 5 years. So for a 2018 NOL, which can potentially get generated from all the other provisions that I discussed, you can go back to 2013 and claim a refund for that year. And if you have excess losses, you can go to 14, 15, and 16 and claim refunds. So this is a way for the real estate industry to try to get cash back, in a relatively short period of time. We don't know how quickly they're going to look at these amended returns and 2019 and 20 filings for refunds. In the past, you can see large claims for refunds take months. With the IRS and the state governments being in shutdown mode, we'll see how things change. But we are looking for further guidance from the IRS and Treasury. Future regulations. There's regulations that still haven't been finalized or implemented since the TCJA. So as far as tax is concerned, there's significant changes in these in the CARES Act.
And so it's safe to assume that work is already underway for the carryback provisions. You're already taking a look into how this is practically applied to real estate clients.
Absolutely. We're looking at everything that was done. We're looking in prior years, what properties were placed in service at the 39-year level for commercial real estate, for restaurants, for all types of clients. This affects tenants that are operating in a business. So yeah, this is huge. It's not just for real estate, it's for every industry, especially when it comes to the NOL provisions and loss provisions.
And you did mention that there were certain parts of the legislation that maybe are not complete or still in more of a draft form. Do you mind just maybe highlighting very high level what those either are or could be? And do you anticipate anything else coming out of this?
Yeah, so there's been temporary regulations on the 163J, which is the interest limitation. We've heard rumblings that they're going to issue final regulations sometime in March, and today's the last day of March, and I do not believe it's been issued. We haven't seen any regulations on 461L, which is the loss provision. So there's still unknowns, with regard to how to implement certain aspects of the Tax Cuts and Jobs Act. And as far as future regulations, with regard to the CARES Act, I think we're going to see some, maybe not regulations, but guidance coming out in really short term, maybe the next 2 weeks to a month, when it comes to a lot of these tax provisions.
So it's safe to say that real estate professionals need to keep their eyes open very much so over the next 2 weeks to see what's next.
Absolutely, because at the end of the day, what the government wanted to do is put money into the pockets of taxpayers that have sustained losses. So absolutely, there's going to be provisions that affect every taxpayer, and real estate is going to be one of the biggest benefactors of some of these changes.
Great. Before we move on, just want to remind everybody that the Q&A portion is open, and we will get to those questions in a few minutes. So I wanted to ask a similar question to Ari. What new legislation do you foresee coming out, and has the real estate industry learned anything at this point?
Sure. So I'm going to take your first question first. Definitely, there's actually a lot of real estate legislation coming out. One thing that I expect will come shortly is legislation to protect commercial tenants and commercial mortgage borrowers and landlords. We're seeing the Governor Cuomo has already enacted through his executive order a 90-day moratorium on evictions and foreclosures, both residential and commercial, which goes until June 20th. And currently, the Department of Financial Services, pursuant to that executive order, has enacted certain regulations to provide forbearance assistance for consumers and individuals in New York State. But as Anthony well knows, we need to protect the commercial borrowers and owners as well, not just residential single family owners. So there is actually right now in the New York State Assembly and Senate, there are pending bills that would potentially suspend rental payments for both any residential tenant or small business commercial tenant that has lost income or been forced to close its place of business as a result of these government-ordered restrictions. And it would actually provide not only that the rent can be suspended, but it's actually waived during this period and that there can't be any late fees. And consequently, if enacted, the bills would provide waiver of mortgage payments as a result. So there's hesitation about that because that could constitute a constitutional issue. So there is some hesitancy about going forward with that. But there are certain bills like that that are not just protecting individuals, but are meant to protect mortgage borrowers, commercial mortgage borrowers as well. Actually, Fannie Mae and Freddie Mac through the FHFA have already put forward regulations that would suspend certain mortgage payments for multifamily owners. And it's actually provided that as long as they don't evict their tenants at the properties. It's not just a free, okay, we won't foreclose on you. You've got to basically protect the individual tenants who are at those properties as well. But on the federal level, we are seeing that already, and we're expecting to see that just like it's for multifamily owners on the federal level with Fannie Mae mortgages. We're expecting to see that also in the New York State level for commercial owners as well. One other thing that we may be seeing going forward is in terms of digital execution of documents. I know there's a lot of talk about e-notaries, and every state jurisdiction is different in terms of that, but especially given this crisis where people want to get deals done and are running into bureaucracies in terms of if certain counties have requirements that everything has to be an original. I think you are going to see a shift of that, depending on the jurisdiction, towards e-recording, e-notarization, and I think that's underway. And one other thing that I found interesting that Anthony mentioned at the beginning in terms of business interruption insurance. A lot of times, traditionally, if there's an issue with the tenant, landlords would have said, okay, it's the tenant, go ahead and look at your business interruption insurance for coverage, don't turn to me. The problem is that, as many people are waking up to find out, that, and this is more of an insurance issue, but that a lot of insurance companies have specific exclusions for pandemics. Who would have thought that would have been an issue? But now that business owners are trying to claim coverage under their business interruption insurance and finding out that pandemics are specifically excluded from there, there's actually legislation underway to try forcing insurers to cover those with business losses due to the pandemic. So we'll see what happens with that, but that's not just in New York, it's in a couple of states, it's ongoing right now.
Wow, that is a very interesting aspect to think about as far as insurance protection and whether pandemics fall under force majeure or any other aspect of the policy. It will be fascinating to watch that play out for sure. So, Anthony, again, you have a slightly different seat than the rest of us here. Is there any legislation that you would want to see come out of this?
Ooh. There's nothing in particular that's on my radar screen. Anything that provides clarity to the marketplace for property, I think, is certainly better. I would support what Ari was talking about, the e-recordings and bringing some of the aspects of overall real estate into the 21st century is much needed, whether that's on the residential side or the commercial side. And so all of that is much needed. But I think anything that really brings clarity to the process and certainty is incrementally more helpful to the industry. I applaud the correction that the government made as it respects to the bonus depreciation. I think that a lot of people were waiting and expecting that would be done, but it just was stuck in the legislative morass. So that was terrific, and we were very encouraged that happened. Interestingly, as it pertains to our specific industry and the focus that we have with our tenants around cannabis, it's fascinating to think through how cannabis is now an essential business akin to a pharmacy. And I would break that down into two segments. If you think about the cannabis industry and how it'll perform during a recession, you have one segment, which is, in my opinion, a small ticket non-discretionary item for those that use cannabis to seek relief medicinally. And then you have, for those that are using it in the adult use segment or the recreational use segment, again, a small ticket discretionary item that I would put akin to alcohol and tobacco. And so we expect those to perform well during a recession. But as that pertains to your question with respect to legislation, it will be interesting to see how this debate about cannabis in the U.S. advances, with 33 states currently providing medical cannabis and 11 states providing adult use cannabis. There are a host of other states that are exploring either expansion of the medical program or implementation of a medical program. And so I think this will open some people's eyes to cannabis as a product that they didn't think was as mainstream as it is today. But I think the states, now here's the side of me that's a little bit more, I'll just say it. I think the states are going to be very self-serving and trying to find another source of tax revenue in an environment where the states will be sorely strapped for locating tax revenue. And so it could be interesting to watch the cannabis industry experience a wave of state legalizations over the coming 12 and 24 months as an outgrowth of this. Again, I think primarily on the back of states wanting increased revenue, but also employment. There was a report out by Bank of America on Friday, which identified over 200,000 people are employed in the cannabis industry today, and it's the fastest growing employment sector in the U.S. And so a state being able to bring not just tax revenues, but more jobs to that state, we think may have an interesting legislative angle, albeit not real estate oriented.
Great. You definitely have a different perspective than us, and it's incredible to hear. So at this point, we're going to open up the Q&A. We already have a few questions in there, so we'll just start at the top. So from Adam, in regards to residential leases, how will landlords be able to protect themselves, especially with the restrictions on security deposit collections up front? So Luca, Ari, if either one of you would like to take that question.
Sure. So I'm not sure if I understand the question fully, but the security deposits are still held by the landlord. So again, you got to look at what the lease says if there's a default under there, but the security deposits, as long as they're being held, they've been deposited already, the landlord is holding on to those. So there's no real harm to the landlord in terms of the security deposit. it's really the tenant who would be concerned in terms of there's a default with that. But from the landlord's perspective, there's no issue as long as they're still holding the security deposit. Now going forward, what I mentioned before, that the landlord, if there's going to be a modification of the lease going forward to try working something out with the tenant, at least in the commercial sphere, maybe requesting an increase in the security deposit to kind of secure themselves better in case anything, God forbid, happened like this again.
And so just to speak about this a little more generally, what protections do you anticipate for landlords as we move forward?
I figure that in terms of the leases, look, if the landlord has a security deposit and can draw on it or take it if the tenant is in default, I think they're going to try making those tighten the provisions in the lease about that. So that way they could use that. If the tenant's in default not paying its rent and doesn't have a solution that's amenable to the landlord, again, going back to we want everybody to work it out. The parties want themselves to work it out. But if they can't, the landlords will want to be protected in terms of making sure that their lease is ironclad, that look, even if I'm losing this tenant, that I can at least claim their security deposit, unless there's a guarantor that they can go after.
Yeah, this is Anthony. I would jump in there. I think, again, this dialogue really depends on who the parties are. I think in a multifamily setting where the lease is generated by the landlord and individuals don't have an opportunity to comment on it or review it, or quite frankly, they can't afford to hire a lawyer to review it, or they don't want to or don't take the time and they just sign their lease, the landlords will be able to dictate their terms in those instances. And then I think it'll be up to the states to regulate those lease provisions and dictate to landlords in those circumstances what might be too onerous or where that line is. I think on the commercial real estate side, I think it'll be a function of the marketplace. I think it'll be a function of what landlords can get and what tenants can get. And I think we'll see more the supply-demand dynamics of a capitalistic marketplace at play there in terms of those particular lease terms.
Great. Next question we have, are there any special provisions for restaurants? And specifically, are there any special provisions for landlords whose major tenant is a shuttered restaurant? So as we know, the restaurant food service industry is being particularly affected by the coronavirus. What special provisions have we seen to this point? And that's from Mark.
Yeah, so, I don't know if there's anything specific at this point to restaurants. I read an article, I believe it was in The Real Deal last week, that a bunch of restaurant chains are banding together in terms of going forward to present a unified front to landlords in terms of what they want in terms of waiver payments for certain provisions. But, like kind of going to what Anthony said in terms of leverage, these restaurant owners are realizing that they're much stronger as a unified group than individually. So, and again, there may be legislation coming forward with commercial, but I think that's what they're trying to do, trying to take the bull by its horns and come as a unified front, and we'll see where that gets them. It's kind of up in the air at this point.
Great. The next question, and Luca, this one's for you from Anonymous. Can you elaborate a bit more on the depreciation provisions? Which asset class does it apply to? And what do you think the implications are?
Sure. So with regard to the qualified improvement property, the rules are specific in what qualifies. It's interior, non-residential interior space, and historically they've been considered qualified leasehold improvements, qualified restaurant improvements, etc. in the past, and those were always eligible for 15-year depreciation life and bonus depreciation. So under the TCJA, it was, they called it a retail glitch. It wasn't in the code as modified. So the real estate industry and several other industries have been pressing the government to come out with a technical correction. It's been an issue ever since the TCJA came out. It was a political play, obviously, with Democrats didn't want to go after the that they didn't want to make that change in the legislation. So it's a 15-year class life where it was 39 years straight line. It's eligible for 100% depreciation. So it's going to be a huge impact to not just real estate, but a lot of different businesses. And that's going to be through 2022, where you're eligible for 100%. And then it obviously scales back starting in 2023. I think it's going to create a significant amount of deductions for a lot of taxpayers, especially in real estate.
Great, thanks, Luca. We have time for one last question, and this one I think is right up Anthony's alley. So many cannabis companies are pre-revenue, and they seem to require further funding. How big do you see the risk of folding?
It is the single biggest concern we have whenever we look to underwrite a new tenant. We tend to focus, so you're absolutely right, many of these companies in the cannabis sector are new companies with limited operating history, limited cash flow, and limited profitability. We underwrite the property, so we understand the alternative use. We underwrite the operator and their cash flow profile. We also underwrite our level of rent relative to cash flows at the property. And while all of our properties are generating above market rent, I will tell you that all of these properties are generating above market revenue for the property on a per square foot basis, whether that's industrial properties that we own for cultivation and manufacturing of cannabis products, or whether it's retail dispensaries that we own. And so we look at the rent as a percent of revenue that we charge, and it tends to be anywhere from 3 to 7% of the revenue that's generated by the location. We obviously underwrite the management team and understanding how they've managed businesses before. But fundamentally, we want to make sure that we underwrite the real estate to know if we ever had to take the property back and utilize it for a non-cannabis operation, what would we get for that property. And then the last element of it, and this is probably one of the more critical ones, is we focus on what's called limited license states. States such as New York, where there are only 10 cannabis cultivation licenses across a state of 20 million people. And in these states, the license itself tends to be attached to the property and vice versa. And with a state like New York, where there are over 200 applications and only 10 awarded, there is a long list of parties that did not win a license that would love the opportunity to step into someone who's defaulted and someone who is being forced to monetize that license. And therefore, we think that even if we get it wrong in these limited license states for the operator, someone else will step in to purchase the property so the existing operator can capture the intrinsic value of that license and not have the Cannabis Commission take it back only to award it for somebody else. They might as well get, and I will just tell you, some of these licenses, depending on the state, they go for $10 million, $20 million, $30 million just for the license. And so there's a tremendous amount of intrinsic value, which creates significant impetus for a faltering operator to monetize that value and sell it to a healthier company, and thus a healthier tenant for us.
Perfect. So now that we're approaching the top of the hour, let's maybe take a moment for final thoughts. So Anthony, since we have you on the board right now, any final thoughts, anything that you think the real estate professional at large needs to know?
I would go back to where I started, which is April, in my opinion, is going to be a volatile month. I think for the real estate professional, being adaptable, communicative, cooperative, and constructive will be the critical skill sets that will really establish those that will grow and thrive post-crisis versus those that will struggle to emerge from the crisis. because what we do over the next 30 days as real estate professionals really will set that reputation and relationships that will follow us for years to come.
Perfect. Ari, final thoughts?
Sure, yeah. I unfortunately think it's going to be a leaner real estate market afterwards. Unfortunately, there are going to be companies that go out of business. And I think there's going to be some hesitancy afterwards in terms of doing deals. This is going to be fresh in everybody's mind. This isn't a one-day thing. This is, who knows really how long it's going to continue. And I think that even after the recovery begins, there is going to be some hesitancy about going forward, given what we're experiencing now. But I do think that kind of with the general economy as a whole, that we are going to turn the corner and that life is going to go on and the real estate market is going to flourish like it did beforehand. It may be a little bit different than it was before, and there may be new legislation, new updates, but I think we are going to, the real estate market, especially in the New York tri-state area, is going to flourish and be booming again.
Great. And Luca, to close this out?
Yeah, so I think the industry is obviously going to change in the short term. There's so many different types of businesses that fall into the bucket of real estate. So some segments will do better than others. And I think the real estate industry obviously is going to take a huge short-term hit, and the long term is going to depend on, especially in the middle market, what types of properties and what's in their portfolio. If the building and operations are newly acquired in the last 2 to 5 years, let's say, so they purchase at the highs. If rents take a major hit because of the way humans have changed due to the pandemic, who knows what the impact will be on real estate. But I will say that the real estate families that have liquidity, I think they're going to thrive in this market, especially if valuations go down in the short term. They're going to be able to take advantage of that. Mortgage rates continue to stay low. And, I wanted to echo something. I forgot if Ari or Anthony mentioned it with regard to office space. I'll say this, in the accounting profession, a lot of the, top 10, 25 firms, they've already been moving towards a work from home mentality for their practices. And I think, and same here with Janover, once this pandemic hit, I think we are all starting to realize that working remotely is possible efficiently in several different industries. So, we'll see what the office space segment is going to be in the future. This pandemic has changed real estate dramatically in the short term, and we'll see how we turn around it for the long term.
What a way to close it out. That was perfect. So with that being said, this is the conclusion of our third webinar. I want to thank you all so much for attending, and to the panelists, again, thank you for putting on a great show. This was incredible, some of the details that we went through. So again, thank you so much for participating. To everyone out there, we will be doing another webinar on Thursday. This time we will be speaking about small businesses and the effect that the COVID-19 pandemic has had. So please tune in at that point. We'll be sending out further details as we get closer. Thank you so much.